I'm Sophie Earnshaw, Joint Manager of the Baillie Gifford China Growth Trust. This has been another volatile year for Chinese growth equities. Looking backwards, the returns we've delivered to shareholders over this period have been disappointing. But looking forwards, we feel increasingly optimistic about the asset class, our existing portfolio companies, and the new opportunities available to long-term growth investors in China. Now, there are thousands of listed companies in China, but for the Baillie Gifford China Growth Trust, we're focused on a portfolio of just 60 of the very best. And by best, we mean those that participate in disruptive and secular trends, and therefore we believe are likely to deliver strong growth over the next 5 to 10 years. Now, our focus on individual growth companies and on the long term means that we think very differently to the market and we aim to perform very differently to it. But the key drivers of performance in the last 2 years have been macro events rather than individual companies. The aim of the China Growth Trust is to outperform our benchmark over rolling 5-year periods. For the year to the end of January 2023, the NAV return was negative 5.7%, whilst the benchmark return was negative 2.2%. Our share price return was negative 7.9%. This follows very weak returns in the year prior. Now, while we expect periods of underperformance on the road to capital appreciation, we are keenly aware that this has been a painful period for our shareholders. We believe there are 3 main macro drivers behind the weak performance of Chinese equities. First, zero COVID. Second, the regulatory clampdown. And third, geopolitical tensions. But fast forward to today, and 2 of these negative drivers have been resolved, while some of the market's worst fears about investing in China have been disproved. The government has completely dismantled zero COVID and ended the regulatory clampdown. In addition, it's put forward a markedly pro-growth agenda, reiterated its commitment to wealth creation and its support for the private sector. Economic growth is rebounding, sentiment towards the asset class has improved, and the stage has been set for a strong period of domestic growth. In terms of relative performance, I'd say it's been a tough time for growth investors in China. The types of companies that did well in share price terms, such as state-owned enterprises or oil companies, don't fit with our investment philosophy. But importantly, the companies that we do own have delivered strong operational performance, and we believe it's only a matter of time before this strong operational performance is rewarded by strong share price returns. A good example is Asimchem. It's grown its earnings by over 200% over the last 2 years, but features as one of our top detractors. The market is overlooking this exceptional operational performance for regulatory reasons that we think don't matter. So China is in a good place, both cyclically and structurally. The companies we own are performing well operationally, and we therefore think this positions us well for the long run. That being said, drawdowns and periods of market volatility are the norm rather than the exception for Chinese equities. Indeed, the propensity for volatility has likely been heightened by the increasingly competitive relationship between China and the US. As such, this remains an asset class with big risks and big opportunities, and one that's only suitable for those with the appropriate risk tolerance and long-term time horizon. One of the reasons we're confident in our future performance is that the opportunities for growth investors in China have remained remarkably consistent during this period of volatility. Now, we believe the China Growth Trust portfolio is geared into these long-term opportunities and represents a selection of the best and most innovative public and private Chinese growth companies on offer. Now, these include our investments in companies such as LONGi, the world's largest solar manufacturer. Companies such as Innovance that are contributing to China's ambition to advance its manufacturing capabilities in robotics and automation. Little giants such as SG Micro that are developing technology in strategically important industries such as semiconductors. Software-related companies such as Yonyo that are helping traditional industries become more efficient. Leading domestic brands such as Li Ning that have the scope to challenge foreign brands within China and abroad. Compounders within the platform economy that continue to add value to consumers' lives. In short, companies that we believe are likely to contribute to China's development over the next decade. Now, over the year, we've bought a range of companies that are exposed to these themes, such as Dongguan Yiheda in automation, or Jiangsu Azure in batteries. We've added to a number of stocks and valuation grounds, including Alibaba and China Merchants Bank, and we've sold a number of our lower conviction holdings, including Tencent Music and Bilibili. To conclude, I want to say thank you for your support. While we know this period has been difficult, I hope I've been able to convey the excitement that we still see in China and the opportunities open to growth investors there. We continue to believe that China offers an attractive mix of risk and reward for those investors with the appropriate risk appetite and long-term time horizon.